Recording in progress.
Okay, and welcome back today, guys, to our webinar, Chapter 2, Trading Essentials. And today, of course, we will be talking about something else, a very different topic. And this topic will include what we call trading essentials, which, first of all, we talk about stop losses. Then we talk about various other things that most traders never pay attention to when trading on the financial market. Of course, trading essentials are very important ways of making good profits from the market. Most reasons why people don't accumulate profits is because they don't know how to minimize their stop losses, know when to close out of a losing trade, and etc. Things like that. So right now, right away, we'll be talking about what is a stop loss, how to impute stop losses, and the rest of it. So let's begin the day. Next page, please. Now, types of stop losses and why does my stop loss keep getting hit? Let's face it, the market will always do what it wants to do and then move the way it wants to move. Every day is a new challenge, and almost anything from global politics, major economic events, to central bank rumors, these things kind of cost on currency prices one way or another faster than you can always imagine. Now, this means that each and every one of us will eventually take a position on the wrong side of a market move. But being in a low losing position is actually inevitable, but we can control what we do when we are caught in that situation. So you can either cut your loss quickly or you can ride it in hopes of the market moving back in your favor. Now, of course, that one time it doesn't turn your way, it could blow off your account and end your boarding trading career in a flash. But then the saying, live to trade another day, should be the motto of every trader on Newbie Island, because the longer you can survive, the more you can learn, gain experience, increase your chances of success, etc., etc. And this makes the trade management technique of stop losses a crucial skill and tool in a trader's toolbox. Having a predetermined point of exiting a losing trade not only provides the benefit of cutting losses so that you may move on to new opportunities, but it also eliminates the anxiety caused by being in a losing trade without a plan. Now, less stress is good, of course, but so let's not, move into different ways to cut losses quick. Before we get into stop loss techniques, we have to go through the first rule of setting stops, which is your stop loss point should be the invalidation point of your trading idea. And when price, hits this point, it should signal to you that it's time to get out. It's next session. And of course, you discuss different many ways of setting stops. And we're going to take our time to ensure that you all understand how you can possibly do this easily. Next page, please. Now, there are four methods you can choose from. One, you have percentage stop. We have the volatility stop. We have chart stop. We have the time stop. And of course, how to set a stop loss based on a percentage of your account. Let's start off with the most basic type of stop, which is the percentage-based stop loss. The percentage-based stop uses a predetermined portion of the trader's account, let's say 2%, that the trader is willing to risk on a trade. And the percentage risk can vary from forex trader to forex trader. More aggressive ones risk up to 10% of the account, while less aggressive ones usually have less than 2% risk per trade. Now, once the percentage risk is determined, the forex trader uses this position size to compute how far he should set his stop away from his entry. And of course, this is a good thing, it's a good thing because a trader is putting a stop, which is in accordance with his or her trading plan. And of course, you should always set your stops according to the market environment or according to your system rules. and not how much you want to lose. We bet you're thinking right now, like, this doesn't make any sense, but you should understand that we agree this sounds confusing, but we also explain with an example. You know, you have the newbie mini account with $500 and minimum size can trade is 10K units. Newbie net decides to trade GBP USD as he sees the resistance at 1.5620 has been holding. And as per his risk management rules, Ned will risk no more than 2% of his account per trade. And at 10K units of GBP USD, each peep is worth $1 and 2% of his account is $10. So the latest or rather the largest stop net can put on is 10 pips, which is what does on his trade by putting his stop at 1.56 630. Next page, please. Now, let's take for instance, you're seeing the GBP USD chart. GBP USD moved over 100 pips a day. It could easily get stopped out at the smallest move of 10 15 pips, but because of the position limits his account is set to, he is basing his stop solely on how much he wants to lose instead of the given market conditions of GBP USD. Now let's see what happens next. And before you know it, Ned got stopped out right at the top because his stop loss was too tight, and aside from losing his trade, he missed out on a chance to grab over 100 pips. Now, from that example, you can see that the danger with using percentage stops is that it forces the forex trader to set his stop at an arbitrary price level, and either that the stop will be located too close to entry, like its newbie net case, or at a price level they don't have technical analysis into account. For all you know, you could be setting your stop right at that level where the price could turn and head your way, but then because you already got stopped out, you wouldn't be able to back those pips down. Now the solution for Ned is to find a broker that suits his trading style and starting capital, of course, and this of course is going to have a huge effect on how his trading plan is obviously going to go. Next page, please. Now, in this case, Ned should trade with a forex broker that allows him to trade micro or even custom lots. At 1K of GBP USD, each pip is worth $0.10. And in order for Ned to stay within the risk comfort level, he can set a stop on GBP USD to 100 pips before losing 2% of his account. And he now has the ability to set his stop to the market environment, trading system, support and resistance, and etc. like that. But then, how to set a stop loss based on support and resistance from charts? We have a more cynical and sensible way to determine stops, which would be to base it on what the charts are saying. So since we are trading markets, we might as well base our stops on what the markets are showing us. One of the things that we can observe in price action is that there are times when prices can't seem to push or break beyond certain levels. Now, other times when these areas of support or resistance are tested, they could potentially hold the market from pushing through once again. So setting stops beyond these levels of support and resistance makes a whole lot of sense, because if the market does trade beyond these areas, then it is reasonable to think that a break of that bring in more traders to play the break and further push your position against you. Now, if these levels do break, then there may be forces that you are unaware of suddenly pushing the market one way or another. And now let's take a quick look at a way to set your stop based on your support and resistance. Take a look at this. Now, you are breaking above the trend line. You already drew a trend line downward, and you buy above the red line, but where do you set your stop is the important thing. On the chart above, we can see that the pair is now trading above the falling trend line, and you decide that this is a great breakout trade setup, and you decide to go long. But before you enter your trade, ask yourself the following questions. Where could you possibly set your stop? Which is very important. Next page, please. Next page, please. here. The most sense to set your stops below the trend lines and support areas. Our previous page, I think you moved the page ahead. Now it's important if you want a real life example, you take a look at Hack's trend line on Euro USD, how to step a stop loss based on price volatility. To put it in simple terms, volatility is the amount a market can potentially move over a given time. And knowing how much a currency pair tends to move, you can help you set the correct stop loss levels and avoid being prematurely taken out of a trade on random fluctuations of prices. For instance, you are in a swing trade and you know that Euro USD has moved around 100 pips a day over the past month, and setting your stop to 20 pips will probably get you stopped out too early on a small intraday move against you. But knowing the average volatility helps you set your stops to give your trade a little breathing room and a chance to be right, as we explained in a previous lesson. One way to measure volatility is by using the Bollinger Bands. You can use Bollinger Bands to give you an idea of how volatile the market is right now. And this, of course, can particularly be useful if you're doing some, range trading. Simply set your stop beyond the bands, and if price hits this point, it means volatility is picking up and a breakout could be in play. As simple as that. Next page, please. Next page, please. Now, having a look at the chart, you already see where you can place your stop based on the market with your RSI in focus. Another way to find average volatility is using the average true range ATR indicator, and this is common indicator that can be found on most charting platforms, and it really, it's really easy to use because all the ATR requires is that you impute a period or amount of bars, candlesticks, or time it looks back to calculate the average range. And for example, if you're looking at the daily chart and you impute 20 into the settings, then the ATR indicator will magically calculate the average range for the pair over the past 20 days. Or if you're looking at an hourly chart and you impute 50 into the settings, then the ATR indicator will show you the average movement of the last 50 hours. Pretty different and pretty sweet, huh? Now, the process can be applied by itself as a stop or in conjunction with other stop loss techniques. Taking a look at this, you place your stop right above the resistance and aim for the next support as your take profit, of course. And the point is to give your trade enough breathing room for fluctuations because they will always happen here and there before it heads your way finally, and hopefully it does head your way. Next page, please. Now, how to set a stop loss based on a time limit. Time stops are stops you're set based on predetermined time in a trade. It could be a set time, open limit time of hours, days, weeks. For instance, let's say you're in an intraday trader and you have just put on a long trade on EuroChef and it hasn't gone anywhere. We're talking real smooth, like here, and no movement for like 3 whole days, and you keep your money locked up in this trade. And when you finally get a breakthrough, you use it to take advantage of that one entry. You see, you set your stop based on a good time limit, and it happened exactly just as you had planned it. Next page, please. Now, more movement, more pips. Because of your predetermined rules and the fact that you do not like to hold trades overnight, you have decided to close the position at 4 p.m. when you're usually done for the day, and you go off to your bi-weekly poker tournament, or maybe you are a swing trader and you decide to close your positions on a Friday to avoid gaps and weekend event risk, and also having some margin tied up in a dead trade would be costing you an opportunity to another great trade setup, because somewhere else you set a time limit and out of the dead wait so that the money can do what it's meant to do, make more money for you. Now, 4 big mistake traders make when setting stops. One is placing stops too damn tight. You shouldn't place your stops too damn tight, especially if you are a beginner trader. Or sometimes advanced trader even do this, because sure, it's one way to practice proper risk management, but when it's used incorrectly, it could lead to more losses than wins, and you don't want to end up like that. Next page, please. The first common mistake is placing stops tighter than those leather pants. And the big pippin used to wear back in the retro days, they are so tight that there ain't no room to breathe. It's in placing ultra tight stops on trades, there won't be enough breathing room for the price to fluctuate before ultimately heading your way. Now, always remember to account for the peer's volatility and the fact that it could, daily around your entry point for a bit before continuing in a particular direction. For instance, let's say you went long on GBP JPY at 145 with a stop at 144.90. Now, even if you're right in predicting that the price will bounce from that area, it is possibility that the price will still do a dip 10 to 15 pips lower than your entry price before popping a bit higher, probably until 147.0. But guess what? You weren't able to rake in a 200 pip profit because you got stopped out in a jiffy. So don't forget, give your trade enough breathing room and take volatility into your account. Okay. Number two, using position size like X number of pips as a basis for stops. We have mentioned this earlier in this lesson already. Using position size like X number of pips of X amount, instead of technical analysis to determine stops is a really bad idea. We have learned this as a newbie and we keep relearning it. So as discussed, using position sizing to calculate how far you stop has nothing to do with how the market is behaving. Since you're trading in the market, of course, it's will make you much sense to set stop loss depending on how the market moves. Now, after all, you picked your entry point and targets based on technical analysis, so you should do the same for your stop too. Now, you're speaking position size to risk, it's the size of stop loss, which is a no-brainer. But then you have size of stop loss to risk and then position size. I think that's the correct way, right? Next page, please. Now, placing stops too far or too wide. A few traders make the mistake of setting stops way too far, crossing their fingers that price action will head their way sooner or later. Well, what's the point of selling stops then? What's the point of holding on to a trade that keeps losing and losing when you can use that money to go for a more profitable one? Setting stops too far increase the amount of pips your trade needs to move in your favor to make the trade worth the risk. The general rule of thumb is to place stops closer to entry than profit targets. And of course, you don't want to go for less risk and bigger reward, right? With a good reward risk to risk ratio, let's say 2 to 1, you'll be more likely to end up with profits if you're right on the money with your trades at least 50% of the time. Now, placing stops exactly on support and resistance levels, setting stops too tight, setting stops too far, where exactly is a good stop placed, well, not exactly on support or resistance level, we can tell you that. How come? Don't we just say that the technical analysis course, the way to go with determining stops, it's helpful to always note that nearby support and resistance levels when deciding where to place your stops are way important. But why isn't it a good idea to put it right smack on the support or resistance level? The reason is this, that the price could still have a chance to turn and head your direction upon reaching that level. Now, if you're going long, you can just look at the nearby support level below your entry and set your stop loss in that area. If you're going short, you can just find out where the next resistance level above your entry is and put your stop around there. Now, if you place your stop a few pips beyond the area that you would be more or less sure that the support or resistance is already broken, and you can then acknowledge that your trade idea was wrong. Now, rules to follow when using stop loss orders, very importantly. Once you've done your homework and created an awesome trade plan that includes a stop out level, you now have to make sure that you execute those stops if the market goes against you. Now, there are ways to do that. One is by using an automatic stop and another through a mental stop. Which one is best suited for you? You need to know this. Here's where the hard part comes in, as the answer to the question lies in your level of discipline. Do you have the mental toughness? You have self-control to stick to your stops in the heat of battle? What often separates the long-term winners from the losers is whether or not they can objectively follow their predetermined plans. Make sense? Next page, please. Now, traders, especially the more inexperienced ones, often question themselves and lose that objectivity when the pain of losing kicks in and brings in negative thoughts like, maybe the market will turn right here, I should hold a bit longer and then it will go my way. If the market has reached your stop, your reason for the trade is no longer valid and it's time to close it out. No question being asked or question needed. And that is why the almighty forex gods invented limit orders. New forex traders should always use limit orders to automatically close out a losing trade at predetermined levels. Now, this way you won't give yourself the chance to doubt your plan and make a mistake. You won't even have to be sitting in front of your trading station to execute the order. Now, of course, the more trades and experience you have under your belt, the more you will hopefully have a better understanding of market behavior, your methods, and the more disciplined you will be. Only then would mental stops be okay to use, but we still highly recommend limit orders to exit the majority of your trades. Manually closing those trades leaves yourself open to making mistakes, especially during unforeseen events such as entering the wrong price levels, or position size, a power outage, a coffee binge, a juice bait from a marathon, etc. like that. But don't leave your trade open to unnecessary risk, so always have a limit order to back you up, because stops are never set in stone and you have the ability to move them, which will end this lesson with 3 rules to follow when using stop loss orders. Next page, please. Don't let emotions to be the reason you move your stop. You like your initial stop, your stop adjustment should be predetermined rather, before you put your trade on. Don't let panic get in the way. 2, don't trade your stop. Trading your stop means moving it in the direction of a winning trade, and this locks in profits and manages your risk if you add more units to your open position. 3, don't widen your stop. Increasing your stop only increases your risk and the amount you will lose. Now, if the market hits your planned stop, then your trade is done. Take the hit and move on to the next opportunity. Widening your stop is basically like not having a stop at all, and it doesn't make any sense to do it. Never widen your stop. These rules are pretty easy to understand and should be followed, let's say, religiously. Don't widen your stop. It's never overemphasized. You find a good broker that allows you to trade positions like Zitrodex. Let's use the size of your capital and risk management. Use a predetermined alert in this lesson, which is all you should always know that when to get out of your open positions, set stops to the current market environment, framework. Do not set your exit levels to how much you're willing to lose. Okay. Find the stop levels that prove your trade wrong first, and then manage your position according to it. Next page, please. So that's a wrap on today's webinar about stop losses. I hope we enjoyed today's class, and always have in mind stop losses are a way to gain. If you're able to cut out your losses, then you're able to accumulate lots and lots of profits from the financial market. As simple as that. With all that being said and done, thanks for today. See you guys again next week.